Welcome to This is Supercritical, a podcast where experience, equity, and expertise converge to examine current trends in the cannabis industry. You can find all of our podcasts on your favorite streaming service and at supercritical.agency, your one-stop destination for all things cannabis. Hello, I'm Kerry Jordan, co-founder of Supercritical. Joining us today on This is Supercritical is Barbara Webb, tax partner with MGO LLP, one of the United States' fastest growing CPA and advisory firms. Barbara will help us break down the most relevant tax and accounting issues for cannabis enterprises. Barbara, we're so grateful to have you with us today. Thanks for joining us.
Thanks, Kerry. I'm very happy to be here. Thank you for the invitation, and I'm looking forward to talking for a bit on my favorite topic, this crazy industry.
Well, it really is so confusing out there, so we're especially pleased to have you help us understand more how companies can navigate the landscape of the U.S. tax code as well as state tax codes. But before we begin on that, I'd love to know, where'd you come from, and how did you end up leading a major cannabis practice for MGO?
Well, I think there are two stories here. One is the story of how I came to MGO, and one is about cannabis, working in the cannabis industry more generally. So coming to MGO was really just seizing an unplanned opportunity. A firm based in California recruited me to, I was not even a partner yet, at the firm I was at, a large regional firm in Chicago, to basically help start a new office for them in Chicago. And that's not an opportunity that comes along very often. So I took the chance. I said yes. It was not what I had planned to be doing at that point in my life, but it's definitely been an adventure. And I have to give it to MGO. I think that one of the firm's strengths and differentiators is taking chances on people, sometimes unconventional people. So we've got a great group over there. And I mean, what other firm in the top 75 at the time, top 75 accounting firms, largest in the country? Now I think we're in the top 50. Takes.
Congrats.
Oh, yes, thank you. More to come. So what firm in the top 75 public accounting firms takes a bet on two women who aren't even partners and says, come start this office from scratch. We think you can do it. We'll give you some support. Let's try it. No firm does that, just MGO. And we opened our office in February 2020. So yes. So we opened our beautiful office on the 43rd floor of 155 North Wacker, and then had to go home 4 weeks later, or 6 weeks later. But so a few things converged, and I think one of them was the pandemic. We were supposed to, be a generalist office. My partner in Chicago, my co-founding partner, Sarah McGuire, we both came from generalist backgrounds. She was on the audit side. I was on the tax side. And the mandate was to, go out there and build an office in Chicago made up of, the typical Chicago strong businesses, manufacturing, tech, startups, the whole gamut there. But in January of 2020, a few things were happening in the cannabis industry. There was a lot of M&A going on. There were a lot of go public transactions happening or being planned. So there were a lot of roll-ups, and all these companies that were being rolled up into larger companies, they all needed audits. They all needed to file back tax returns or tax diligence or tax provisions. So there was just a lot of work at the time.
Well, let's get to the major pain point for a lot of cannabis companies in the U.S., which is taxes. Given the restrictions of IRS Section 280E, which prohibits cannabis businesses from deducting ordinary business expenses, what are some of the strategies that you employ on behalf of your clients to help them manage that and to really reduce their overall tax position?
Well, that's an interesting question. Some of the answers have remained consistent over the past 5 years that I've been working in the industry. For the past 5 years, I've spent about 90% of my time working in the cannabis industry. So things that have not changed would be the importance of good books and records. I know that sounds boring, but it is so true. And I think in some cases, companies, even startups, are a little bit better at starting off keeping good books and records. Maybe there's a little more awareness around the importance of that, because that's where you have to have good books and records first. So Sarah and I go to market together. We talk to a lot of prospective clients together, and usually they contact one of us and say, we need help with tax strategy. And so in that initial conversation, I will ask some probing questions like, when's the last time you closed your inventory? And if they say, what does that mean? I say, I think you need to talk to Sarah first before you talk to me. So good books and records on the accounting side is absolutely crucial because, and the tax court cases that we have that deal with 280E, several of them really, it was low-hanging fruit for the IRS and the tax court because the companies didn't have good books and records. So they were almost, finished before they even started, because that you have to have that. And then once you have good books and records, you can start to make some decisions. And I'm oversimplifying here. There's a lot of structuring considerations and other considerations that flow into that. But now we can start to talk about risk with the client and where they are on the risk tolerance spectrum. I have certain parameters within which I can professional standards that govern what kinds of tax positions I should and can sign off on. So I start off by explaining to them, here's the most conservative approach, and this is going to be different for cultivators and manufacturers versus retailers. And then we have this interesting gray area of distribution and some of the other almost ancillary like services that are coming up. So retailers, they don't have a lot of choices. I mean, if the most conservative point of view would be wholesale cost of the product, that's what you can deduct from your gross income, and that's it.
And share with our audience a little bit around the history of Section 280E and why cannabis businesses have this requirement.
Sure, and I'm going to get some of these facts wrong. I'm not an attorney. I didn't study this part before I came to the podcast, but that's okay. There was a case, I'm going to even get the year wrong, probably 1981 or something like that, with a cocaine dealer where he had some tax problems, and his counsel went to court, I believe, and his counsel was advocating for his client to be able to deduct at least the cost of obtaining the product from his total sales, even if he couldn't substantiate, let's say, other deductions, or because I think at first the court was not going to allow any of that to happen. And he was able to win that sentiment and deduct the cost of obtaining the product. And that led to some congressional action where this 280E is actually a statute. It's a federal law that was passed by Congress, and it's very short. It just says no credit or deduction, I'm paraphrasing here, should be allowed for a trade or business that is basically trafficking, keyword there, in a controlled substance that's listed on within the meaning of Schedule 1 and 2, 1 or 2 of the Controlled Substances Act.
So moving over to the income side of things, how do you advise your cannabis clients in terms of maximizing the allocation of expenses to cost of goods sold under Section 280E?
First, you want to think about in terms of if you're a cultivator or a manufacturer, what is a cost of production? And if you're a cultivator, I would expect, and say just on a separate company basis, separate business line basis, that you could probably get about 85 or 90% of your costs into cost of goods sold, because most of these facilities, as I'm sure you know, they're big, giant, kind of just grow facilities, whether they're old warehouses or an old Kmart, and that's all they do is they grow product in there. So the cost of running that facility, the depreciation of the facility and the equipment, the wages, the security, most of all of that can be considered a cost of production. And where we like to start this is where I partner with Sarah on the accounting side when possible. It's best if you were to start with GAAP, generally accepted accounting principles for inventory costing, or something that we call GAAP-ish, because it's only GAAP really if you have an audit and you have somebody sign off that it is GAAP. So Sarah uses her judgment on the GAAP side, and you can really get most of those costs for manufacturing and cultivation into cost of goods sold. And I think what people need to understand and remember is that cost of goods sold is an inventory costing exercise. So this is a balance sheet exercise first, figuring out what is the cost basis of the inventory that's on my balance sheet. And cost of goods sold flows from that balance sheet number. So a lot of clients think about cost of goods sold in terms of deductions, but really they should be thinking about it in terms of the cost of their inventory that's on hand at the end of the year and what costs can legitimately go on their balance sheet.
One of the other challenges that a lot of supercritical clients face is how to expand their company in new states. Because it's federally legal, there's no interstate commerce, so everybody sets up operations or licenses in a new state to help continue to grow. What are some of the primary challenges for companies that are growing in that way in terms of discrepancies between federal tax and state tax?
Well, this is one of those things that makes the cannabis industry challenging to work in. Weird and interesting is the regulatory environment, which makes it a state-by-state business operation with almost no overlap, except for if you have a big holding company paying some centralized expenses. And I think actually, yes, you should know the state's income tax rules, but the local taxes are really key because there's no faster way to lose a license than to get behind on your excise tax, your sales tax, to not realize there was some other kind of little tax that you were subject to that you didn't realize you had to pay, to remain in good standing with the state and the municipality that you're operating in is very high priority, maybe highest priority. And we can talk about this a little later. We're seeing a lot of tax controversy, meaning notices being received from the governments and the taxing authorities in the sales and excise tax area, and those need to be dealt with first because that's how you lose your license, and the officers of the company have actual personal liability for those taxes as well if they fall behind.
So with regard to personal liability, when you're advising your clients, what if they're still in the formation process or if they're in major growth process, what considerations do you have them evaluate when determining whether it should be an LLC or an S Corp or an ESOP, Delaware Corporation? How do you manage all of that from a tax efficiency standpoint?
Sure. So Sarah and I have a joke that if
it's an accounting joke,
it's not, and I don't mean to downplay your question at all. But when we ask a prospective client or a new client, what is your tax filing entity type, and they say we have an LLC, not knowing that means next to nothing from a tax perspective, because an LLC is a state legal entity type that can be. You can make an election if you have an LLC to be a C corporation, an S corporation. You de facto are a partnership if you have more than one owner, or it might not be a tax filing entity at all because it only has one owner. So the first order of business is to figure out what they have legally set up. And then I think the second order of business is not necessarily tax efficiency, is what are your investor expectations? And then I like to temper that a little bit. Do you expect to take cash out of this business? I found that there are a lot of folks from real estate that enter the cannabis industry. And as you may know, real estate is all cash basis. Everything's a partnership. Everyone takes cash out of the business. And so if people say, especially for a cultivator or manufacturer, oh, yeah, we're going to be taking cash out of the business regularly, I tell them how rarely I actually see that happen in a lot of cases, just because those businesses are capital intensive and cash is needed. And then once I understand who are your investors, are you going to be changing investors? So as you know, there are a lot of nominee ownership situations in this business due to licensing requirements. So you might have social equity status requirements. You might have state residency
Maybe
status
you could explain
requirements.
a little bit what that social equity
Sure.
is.
So the different states all have different licensing regimes and may privilege or prioritize certain groups of applicants for the licenses, or mandate a certain percentage of the business be owned by state residents. A lot of times, however, or social equity meaning groups that have been disadvantaged at some point in time, such as possibly veterans, people who are from communities that were harmed by the war on drugs historically. So social equity can cast a wide net and have a wide range of definitions. But there are, in many states, licensing requirements regarding who can be on a license and what percentage they have to own. The reality on the ground is that that's not always where the economics are. So you end up with these situations that this is where it starts to get strange in tax, and where I like to help clients understand the risk that is involved. Because if somebody who supposedly owns 51% of this business but hasn't put any money in, and maybe doesn't have a lot of money in the bank.
Is it often the case that percentage ownership is required for the social equity applicant?
Yes. Yeah, it varies by state. It's very specific by state. So let's say your client wants to set up a partnership. I make them aware that the income, especially if it's a retailer, if you're being taxed on gross margin, if you don't have taxable income, you probably should get out of the retail business because you're selling at less than your cost, right? Mm-hmm. So let's say you're setting up a retail operation and you know you're going to have taxable income because you're not going to sell for less than the cost of your product. And there are people who are going to be receiving that income that's going to flow through to their personal tax returns that are going to have to pay the tax on that. And so I've seen some unfortunate situations where these license holders who are being allocated 51% of the income from a partnership, they don't have money to pay those taxes. And so they're looking to the economic owners or beneficial owners, let's say, of that operation to provide them with tax distributions. And maybe there's no guarantee that those are going to come through. Or if you go to sell and that person, it's a partnership. I always tell clients it's very difficult in a partnership situation to tell the IRS, oh, we were just kidding. These weren't really the owners of this company. You don't want to be in that position, but I think there is significant risk to non-economic owners, license holders who end up in a partnership situation.
And it is tricky establishing who's the owner. For example, let's talk a little bit about M&A.
I have stories about this.
Let's talk about M&A. So a founder, she's built her business, and now she is considering selling it. Mm-hmm. And then with license transfers, there's often a lag time between when the economic consideration is given and when the license is conferred to the buyer.
Exactly.
So during that timeline or along that timeline, who owns the company and how do you manage the tax?
This is an excellent question, very perceptive. And in fact, I'm going to tell the story of the first cannabis client that I ever worked on, and how I'd never seen anything like this in my tax career before. So it was probably July of 2019. I was at my firm prior to MGO, absolutely swamped for the September 15th partnership deadline. And our tax service line leader comes up to me and says, I know you're really busy, but I need to ask you a favor. I said, what? He said, we've got this group of tax returns that absolutely has to be filed by 9/15, cannot be late, and we need you to figure out how to get them filed. So this group of tax returns, this engagement had gone through, I think, 2 senior managers in the tax department, and the team was stuck. And one of the reasons they were stuck is because, well, this was a group of maybe 8 companies, all owned by different ownership groups in different states. and they were all rolling up into one big company, basically. So we had these same questions for every single tax return, for every single group that was being rolled up. Conflicting cap tables, missing documents, discrepancies in time. When did somebody own this and when did they not own it? So it was the first time, to get back to your original question, in my tax career where I found myself asking, who owns this company? And last night, 7:00 at night, I was still asking the same question. Five years later.
I know it's crunch time for you right now.
Yeah. But it's funny how that continues to be. We laugh about it. I laugh a lot working in this industry, probably, when I'm not crying. But that is a question. It's complicated, really, yes. And figuring out when ownership begins and ends in this industry because of the lag time between license transfer and approval, and sometimes sellers are paid in cash and have already walked away, but the license hasn't actually transferred yet. So we talk about that, and I think in tax, there's some flexibility there with this concept of beneficial ownership, because for tax, what really matters is the economics and the beneficial ownership.
Is that the litmus test then?
Not necessarily, because people in the industry, especially regulatory attorneys, get very nervous if the tax returns do not reflect what the state or municipality thinks the ownership is as of 12/31 of that tax year. So sometimes you do end up continuing reporting ownership that legally is true. So that's I don't see anything wrong with that from a tax perspective. Contractually and legally, these folks are still on the license. They are still the owners, but maybe the economics moved on a long time ago. So yes, that creates some very strange situations and confusion. I see a lot of folks come into the industry, or sometimes I'm on a deal with an attorney who maybe hasn't really worked in cannabis before, and it's like deer in the headlights. What is this even? Who owns this company? Still continues to be a question.
It's confusing. We're glad that people like you exist to help us.
Well, thank you for that. But I find that if you're going to work in this industry, I think, whether as an ancillary service provider, and I'm interested to hear if you agree with this, or an operator, you kind of have to be a little bit of that person who runs toward fire, because otherwise I think you're going to struggle. And you also have to be comfortable with a certain amount of ambiguity.
Absolutely agree.
And you also have to be able to make decisions. I think this is where some accountants and other professionals kind of get stuck, because they find themselves unable to dot all the I's and cross all the T's like you would in a normal,
that's for sure,
a normal business. And sometimes it's not clear what the right answer is.
What tax considerations might be different for ancillary businesses, service providers to cultivators or to dispensaries, and how those may be managed most effectively and efficiently from a tax perspective as well as from a cash perspective?
Well, I'm not sure there's an answer here from a tax perspective. And I do think this is one of the most ambiguous areas of, the 280E tax world, is who is a trafficker? And these lines are getting blurrier all the time. I think distribution is very interesting. Some of the distribution models in California where you have to have a license from the state as a distributor, which makes it sound like, well, of course you're subject to 280E. But there are companies who are distributors who never take legal title to the inventory. They never bear any risk of the inventory. They're essentially a software as a service tech platform. And that looks very much to me like an ancillary service provider, even though they are licensed by, the California cannabis authorities and regulatory authorities. And I think that the branding model that has become so prevalent recently, I think, especially in the past 1 to 2 years, is another example where maybe I'm not the manufacturer, I'm not the cultivator, I have a brand, I have specifications for a product that I want to manufacture, but maybe I never hold title to the inventory either. And this becomes very tricky in terms of bookkeeping, accounting, and tax. And so, but that's another example of, are you a trafficker or are you licensing intellectual property for purposes of someone to manufacture and sell it to retailers? And I think contracts are very important here.
You mentioned California, and I know there's been, we have so many stories coming out of California of non-payment of sales taxes, excise taxes, income taxes, as well as companies just not paying their bills and accounts receivables just ballooning. So what are some of the best practices that you can suggest for accounting as well as for reporting to the state? How do you manage all of that?
I'd like to talk about California a little bit because it is a very interesting and in some ways unfortunate environment in which to be an operator right now. I do know successful companies in California. It's not true that everyone in California is failing. I'm sure you do too. Some very successful companies. But there are a couple of factors at play here, and I'm not going to claim to be an on-the-ground expert in the California cannabis world, because it is extremely complicated. And I think that coming from outside California, and even if you're in California, but you're not day-to-day working in the cannabis industry in California, I suspect that you don't really understand how that market works, because it has a longer history than most states. It has a very idiosyncratic history as well. And I think from the legacy structure of the market, some of that has carried over, I think, to the licensed market, state legal market, and it's just very hard for outsiders to understand. There's still lots of handshake deals, lots of quote license borrowing. It can get very confusing in terms of figuring out whose balance sheet does the inventory go on? What are you? Are you a distributor? Are you a retailer? Like, they may have one license, but they really look like this other function. So California is tough because there are just so many agreements that the folks in that state have with each other to get the product grown into market and distributed. It's a very complex system. And the unfortunate thing, to go back to the taxes, the way California used to be set up in terms of taxes, and I think this is at the root of some of the financial problems we've seen, especially with distributors, is that California used to hold the distributor responsible for collecting and remitting both the retail excise taxes and the cultivation taxes. Mm-hmm. So they were responsible for collecting from both. So they're in the middle, the retailer and the cultivator, these taxes. And a lot of these companies did extend payment terms. Maybe they hadn't received the money, but guess what? California still expected those excise and cultivation taxes to be paid when the returns were filed, when they were due, whether you had received the cash or not. The state didn't care. And so what happened was, I think a lot of the distributors got very behind in terms of remitting those taxes, and they got so far behind they could never catch up. California's system is different now. There is no cultivation tax anymore, which is great. And the retailers are responsible for remitting their own excise taxes, which is, I don't know, I think probably how it should have been in the first place. But there have definitely been casualties along the way because of the way that the indirect tax system was set up.
When Supercritical works with clients to help them on capital structure optimization, one thing that we increasingly see is non-payment of federal and state taxes. Mm-hmm. So anecdotally, we hear that this is the IRS is conducting more and more audits, and there is a lot more activity going on between the IRS and these. Can you comment on that for us?
Yes.
Share what your
I definitely can. And it's, just to get real here, there's a cash crunch right now in cannabis. And when I started working in this industry 5 years ago, companies were actually paying their federal taxes. They were paying quarterly. They were concerned about, being up to date on their federal taxes, even just as estimated payments. I think it's safe to say that those days have come and gone. And it's always been the case that paying the state taxes and staying current with the state and municipalities, like I mentioned earlier, is high priority. Unfortunately, it's higher priority than paying your federal taxes, because if you were to pay your federal taxes and then run out of cash to pay your state taxes, you're not going to have a license very long, because you're not going to be in good standing with the state, and you're not going to have a business. So states are generally prioritized first among my clients that do owe taxes to the states. Now, a lot of the states are starting to, for lack of a better term, decouple from 280E, or at least for state legal cannabis businesses, and allow trade or business deductions in the state. And so sometimes companies don't. The state liability is significantly smaller.
I know that's true in Illinois. About how many other states?
Oh gosh, I should know the answer to this. Quite a few. Let's say it's 10 to 14, probably. Okay. I don't have the list in my head, but yeah, there are a lot of companies not paying their federal taxes right now. And this is actually another consideration for thinking about whether you are going to set up as a tax filing partnership or as a C corporation. Because if you're a partnership, the tax liability doesn't belong to the entity. It belongs to the investors. And depending on the kind of investors you have, you may have no flexibility about paying those tax distributions. It depends, I think, what kind of leverage the company itself has in that situation, what the investors are amenable to. Maybe they're okay with not getting tax distributions and fronting that cash on their own. But if you're a C corporation, the tax liability belongs to the business entity itself. So you're really only beholden to the IRS and of course, the state taxing authorities. And maybe you have a little bit more flexibility there in terms of when you're remitting your taxes, if you're willing to take on the interest and penalty liability. And some companies do make that judgment call with more of a considered calculation than others do. But sometimes, especially in this environment right now, we are in a cash crunch, and cost of borrowing is still high. The cost of interest and penalties with the IRS is not necessarily lower than the cost of borrowing. That is a myth. I think that's out there, because there are penalties that can be assessed that cause that cost to skyrocket way above the cost of borrowing. But that's true. And I think also companies got a little complacent during and after the pandemic because the IRS operations had slowed down so much. IRS got behind. They were understaffed. I had companies that didn't pay their 2020 or 21 taxes that never got a notice until recently. So sure, you're going to think, oh, that's not such a big deal, like paying my federal taxes. But now the IRS is catching up. The IRS is hiring an incredible amount. They are staffing up. They're much quicker with their notices. I've never seen federal tax liabilities go to collections, unpaid federal taxes, as quickly as I'm seeing it now. And I think it's just, we're not in the pandemic anymore. The IRS is back up and running as, probably more efficiently than they did in the past, and they have more people. So I think those days where you could kind of maybe skate through without paying your federal taxes for a while, think of those days as being gone too. Okay. And if you don't, I will say this, I think this is important for companies to consider. If you're not paying your taxes and you do go to collections and you're thinking, I just get on an installment agreement and then I'll pay gradually and it'll be fine, no big deal. Well, one of the terms and requirements for being on an installment agreement and maintaining that good standing with that agreement is that you have to be current on your taxes from that day forward. And that includes estimated payments. Oh. So maybe you didn't make estimated payments in the past, but now you're on an installment agreement. And if you miss an estimated payment or you miss your extension payment, your revenue agent can shut your agreement down.
I did not know that.
Yes. And so it's actually a huge cash commitment to go on an installment agreement. and keep it active, and have that be a successful path if you need to catch up on your taxes, because now you're not only paying prior year's taxes, you've got to pay the current year's taxes too at the same time. So that can be very tough for a lot of companies right now
to manage, especially the capital environment that we're in right now. Mm-hmm. Well, thanks for that. Stay current, everyone.
Stay current on your taxes.
Well, one question that we love to ask all of our guests on This is Supercritical is, what do you think is the most supercritical issue facing the cannabis industry today? Well, it doesn't have to necessarily be tax and accounting, but just what do you think is the biggest challenge that they face?
Oh, is there just one? I mean, if there's one, it has to be cash right now. We've kind of already talked about that. Raising capital, cash. I think those are sort of widely known by everybody. I think that the tax burden is really catching up with some companies. If they haven't paid their federal taxes, I think that's a kind of a coming storm. And I think tax accountants who work in controversy and tax attorneys who work in controversy are going to be very, very busy for a long time to come. I think this is a coming storm, and I think it's perhaps not considered as much as it should be in M&A transactions, that these liabilities may be out there.
Well, how can our listeners get in touch with you?
Oh, you could find me on LinkedIn, Barbara Webb. I lead our national cannabis tax practice. I'm sure I'll probably turn up, or Google MGO and my name, and I'll pop up there too.
Fantastic. Well, Barbara, thank you so much for joining us today on This is Supercritical. We've learned so much from you and really appreciate all of the knowledge that you've shared with us and our listeners. Thank you, too, for joining us today, to our faithful followers. If you would like to get a 20-minute consulting session with Supercritical's experts, please sign up at supercritical.agency. And please join us next month, when Sparky joins us with Daniel Firtel, who's the president and co-founder of TRP, a vertically integrated cannabis holding and operating company. And they will be discussing the power of brands and going vertical with cookies and Dr. Greenthumbs. Barbara, thank you so much.
Thank you, Kerry.
With just over a month to go before the U.S. elections, I want to thank the women before me who fought so hard to ensure my legal right to vote. The ratification of the 19th Amendment was formally certified on August 26, 1920, making women's suffrage official nationwide. We now celebrate the date as Women's Equality Day. However, many women, especially women of color, continue to face barriers at the polls, and those discriminatory practices were not formally addressed until the passage of the Voting Rights Act of 1965. On January 22, 1973, women's civil rights and rights to privacy continued to advance with the U.S. Supreme Court's ruling in Roe v. Wade. The court determined our reproductive choices were protected under the 14th Amendment's Due Process Clause, which guarantees the right to privacy. Roe v. Wade remained the law of the land for nearly 50 years until June 24, 2022, when the Supreme Court heartbreakingly overturned this right in Dobbs v. Jackson Women's Health Organization. Of the myriad issues facing our country today, reproductive freedom is especially important to me. It plays a vital role in reducing poverty, promoting public health, advancing personal and family well-being. It empowers individuals to make decisions that best suit their needs and circumstances, and it leads to a healthier and more equitable society. Equity is what makes America great. I'm an incredibly proud mother of 4 amazing children, and I'm grateful that during my childbearing years, I had the constitutionally protected right to choose. Today, my daughters don't have that same right, and that is unacceptable. I'm voting for change. There is so much at stake in this upcoming election. Exercise your right to vote. The women's suffrage movement fought long and hard to attain it.